Question 1. An insured individual has a life insurance policy with a policy loan outstanding. If the insured dies, what effect does the outstanding loan have on the death benefit? A. The death benefit is paid in full, and the loan is then collected from the beneficiary. B. The loan is forgiven, and the death benefit is paid in full to the beneficiary. C. The outstanding loan balance, plus any accrued interest, is deducted from the death benefit. D. The policy will lapse immediately prior to death, and no death benefit will be paid. Answer: C. The outstanding loan balance, plus any accrued interest, is deducted from the death benefit. When an insured dies with an outstanding policy loan, the loan amount plus any unpaid interest is subtracted from the face amount of the policy before the death benefit is paid to the beneficiary. This ensures the insurer is repaid the loan amount advanced from the policy's cash value. Policy loans reduce the actual payout to beneficiaries, so it's crucial for policyholders to understand this impact. Always remind clients that loans against their policy's cash value reduce the net death benefit. Question 2. Which of the following statements regarding the incontestability clause in an Arizona life insurance policy is most accurate? A. It prevents the insurer from denying a claim based on misrepresentations after the policy has been in force for a specific period, typically 2 years. B. It allows the insurer to contest a claim at any time if fraud can be proven. C. It ensures that policy premiums cannot be increased after the first year. D. It dictates that the policy will pay out double the face amount if death occurs within the first year. Answer: A. It prevents the insurer from denying a claim based on misrepresentations after the policy has been in force for a specific period, typically 2 years. The incontestability clause is a vital policy provision designed to protect the beneficiary from delays or denials of claim payments due to alleged misstatements by the insured on the application after the policy has been in force for a certain period, usually 2 years. This clause ensures that once the specified period passes, the insurer cannot contest the validity of the policy, even if there were minor errors or omissions. This provides certainty and security for both the insured and their beneficiaries. Remember, this clause generally does not apply in cases of fraudulent misrepresentation where the intent to deceive can be proven. Question 3. A policy owner in Arizona allows her life insurance policy to lapse due to non-payment of premiums. Which non-forfeiture option would allow the insured to use the policy's cash value to purchase a fully paid-up policy for a reduced amount of insurance? A. Cash surrender value. B. Extended term option. C. Reduced paid-up option. D. Automatic premium loan. Answer: C. Reduced paid-up option. The reduced paid-up option allows the policy owner to use the policy's cash value to purchase a new, fully paid-up whole life policy with a reduced face amount. Unlike the extended term option, which provides the original face amount for a limited time, the reduced paid-up policy offers lifetime coverage, albeit for a smaller death benefit. This option is beneficial for those who want to maintain some level of permanent coverage without paying further premiums. Think of it as trading your current policy's cash for a smaller, completely paid-for policy. Question 4. An insurer providing life insurance in Arizona must obtain a certificate of authority from which entity to transact insurance business in the state? A. The National Association of Insurance Commissioners, NAIC. B. The Arizona Corporation Commission. C. The Arizona Department of Insurance and Financial Institutions, ASDFI. D. The Federal Insurance Office, FIO. Answer: C. The Arizona Department of Insurance and Financial Institutions, ASDFI. In Arizona, all insurance companies and other entities wishing to transact insurance business within the state must first obtain a certificate of authority from the Arizona Department of Insurance and Financial Institutions, ASDFI. This certificate signifies that the insurer has met the state's legal and financial requirements to operate. The ASDFI is responsible for regulating the insurance industry to protect consumers and ensure solvency. Always remember that state departments of insurance, or their equivalent, are the primary regulators for insurance companies. Question 5. Which type of life insurance policy is characterized by a flexible premium and adjustable death benefit, along with a cash value accumulation that earns interest, but does not guarantee a minimum interest rate? A. Whole life. B. Term life. C. Universal life. D. Variable life. Answer: C. Universal life. Universal life insurance is known for its flexibility, allowing policy owners to adjust both their premium payments and death benefit amounts within certain limits. It also features a cash value component that earns interest, although the interest rate can fluctuate and is not guaranteed to be above a certain minimum. This type of policy offers a balance between the permanence of whole life and the flexibility of term, making it suitable for those whose financial needs may change over time. It's often called flexible premium adjustable life. Question 6. A life insurance producer's license in Arizona typically remains valid for how many years before renewal is required? A. 1 year. B. 2 years. C. 3 years. D. 4 years. Answer: B. 2 years. In Arizona, a life insurance producer's license is generally valid for a period of 2 years. To maintain an active license, producers must complete required continuing education hours and submit a renewal application before the expiration date. This biennial renewal process helps ensure that agents remain current with insurance laws, regulations, and industry practices. Mark your calendar for renewal dates and don't let your license lapse. Question 7. What is the primary purpose of the Medical Information Bureau, MIB? A. To provide insurers with credit reports on applicants. B. To act as a clearinghouse for medical information about individuals who have applied for insurance, helping insurers detect misrepresentation. C. To regulate medical practices and ensure patient privacy. D. To assist applicants in obtaining medical records from their physicians. Answer: B. To act as a clearinghouse for medical information about individuals who have applied for insurance, helping insurers detect misrepresentation. The Medical Information Bureau, MIB, is a non-profit trade organization that maintains a database of confidential medical information shared among member insurance companies. Its primary purpose is to alert insurers to potential misrepresentations or errors on insurance applications, helping them assess risk more accurately and prevent fraud. The MIB does not make underwriting decisions itself, but rather provides coded alerts that prompt insurers to investigate further. Remember, insurers must obtain an applicant's written authorization to access MIB reports. Question 8. In Arizona, what is the required grace period for individual life insurance policies, during which the policy remains in force even if the premium is not paid on the due date? A. 7 days. B. 10 days. C. 20 days. D. 30 days or 1 month. Answer: D. 30 days or 1 month. Arizona law mandates a grace period of 30 days or 1 month for individual life insurance policies. This provision allows the policy owner additional time, beyond the premium due date, to pay the premium without the policy lapsing. If the insured dies during the grace period, the death benefit will still be paid, but any unpaid premium will be deducted from the proceeds. The grace period is a crucial consumer protection, preventing immediate lapse due to a slight delay in payment. Question 9. An insured has a life insurance policy with the waiver of premium rider. If the insured becomes totally disabled, what does this rider provide? A. It pays a monthly income benefit to the insured. B. It waives the policy premiums during the period of disability, keeping the policy in force. C. It allows the insured to surrender the policy for its full cash value without penalty. D. It increases the death benefit payable upon the insured's death. Answer: B. it waives the policy premiums during the period of disability, keeping the policy in force. The waiver of premium rider is an invaluable benefit that protects a life insurance policy from lapsing if the insured becomes totally disabled. Should the insured meet the policy's definition of total disability, the insurer will pay the premiums on their behalf, ensuring the policy remains active and the death benefit is preserved. There is typically a waiting period, example 6 months, before benefits begin. This rider provides peace of mind, knowing your coverage can continue even if you're unable to work due to disability. Question 10. Which settlement option provides for the payment of the life insurance death benefit in equal installments for a specified period of time, regardless of the beneficiary's survival? A. Life income option. B. Interest-only option. C. Fixed period option. D. Fixed amount option. Answer: C. Fixed period option. The fixed period option, also known as the period certain option, allows the beneficiary to receive the death benefit in equal installments over a predetermined number of years. If the beneficiary dies before all installments are paid, the remaining payments are typically made to a contingent beneficiary. This option ensures that the funds are distributed over a specific time frame, providing a predictable income stream. It's like setting up a regular payment plan for a set duration. Question 11. All of the following are typically considered components of a life insurance policy's contract except A. The application. B. The insuring agreement. C. The beneficiary designation. D. A buyer's guide and policy summary. Answer: D. A buyer's guide and policy summary. While a buyer's guide and policy summary are important documents that must be provided to a life insurance applicant, they are not considered part of the actual legal contract itself. The life insurance contract typically consists of the application, which becomes part of the contract when attached, the insuring agreement, the insurer's promise to pay, and any riders, endorsements, or amendments. These external documents provide valuable information but do not legally bind the contract's terms. Remember the legal principle that only attached documents form part of the contract. Question 12. A policy owner decides to replace an existing life insurance policy with a new one. In Arizona, what is the producer's primary responsibility in this situation? A. To encourage replacement for a higher commission. B. To ensure the replacement is in the best interest of the policy owner and complete a notice regarding replacement. C. To inform the new insurer only, not the existing insurer. D. To waive all commissions from the new policy. Answer: B. To ensure the replacement is in the best interest of the policy owner and complete a notice regarding replacement. When a life insurance policy replacement occurs, the producer has a significant responsibility to ensure that the transaction is truly in the policy owner's best interest and to mitigate potential disadvantages. Arizona law requires producers to complete a notice regarding replacement form, provide it to the applicant, and submit it to the replacing insurer. This form explains the potential consequences of replacement, such as new contestability periods or surrender charges, and is crucial for consumer protection. Always prioritize the client's financial well-being over commission. Question 13. Which of the following is an example of an unfair trade practice known as twisting? A. Making false statements about the financial condition of an insurer. B. Convincing a policyholder to lapse an existing policy to purchase a new one with the same insurer for no apparent benefit. C. Inducing a policyholder to forfeit an existing policy to purchase a new one from a different insurer through misrepresentation or incomplete comparison. D. Refusing to pay claims without conducting a reasonable investigation. Answer: C. Inducing a policyholder to forfeit an existing policy to purchase a new one from a different insurer through misrepresentation or incomplete comparison. Twisting is an illegal and unethical practice where a producer persuades a policyholder, often through misrepresentation or incomplete information, to surrender an existing life insurance policy and purchase a new one from a different insurer. This practice is detrimental to the policyholder because it often involves losing accumulated cash values, incurring new surrender charges, or restarting contestability periods, all for little or no actual benefit. Producers must always act in the client's best interest, and twisting directly violates that principle. Question 14. An individual purchases an immediate annuity. When would the annuitant begin receiving payments? A. Payments begin after a waiting period of at least 1 year. B. Payments begin at a future date specified in the contract. C. Payments begin within one payment period after the purchase date. D. Payments begin only after the annuitant reaches retirement age. Answer: C. Payments begin within one payment period after the purchase date. An immediate annuity is designed to start providing income payments very soon after the purchase, typically within 1 month or one payment period from the date of purchase. It is funded with a single lump sum, and the primary purpose is to convert that lump sum into a steady stream of income. In contrast, a deferred annuity allows for payments to begin at a future date. Think of an immediate annuity as a rapid conversion of savings into regular income. Question 15. All of the following are examples of how a policy owner can use a life insurance policy's dividends except: A. To purchase a 1-year term addition. B. To reduce the next year's premium. C. To increase the face amount of the policy. D. To pay off a policy loan. Answer: D. To pay off a policy loan. Life insurance policy dividends, which are a return of unneeded premium, can typically be used in several ways: to receive them in cash, to apply them towards reducing the next premium payment, to accumulate them at interest with the insurer, or to purchase paid-up additions, which increase the face amount, or 1-year term insurance. While dividends can help offset financial burdens, directly using them to pay off a policy loan is not a standard dividend option. Instead, you would typically receive the dividend in cash and then use that cash to repay the loan. Question 16. What is the main difference between participating and non-participating life insurance policies? A. Participating policies are typically term insurance, while non-participating are whole life. B. Participating policies pay dividends to the policy owner, while non-participating policies do not. C. Participating policies allow flexible premiums, while non-participating policies have fixed premiums. D. Participating policies are sold by mutual companies, and non-participating policies are sold by stock companies. Answer: B. Participating policies pay dividends to the policy owner, while non-participating policies do not. The key distinction between participating and non-participating policies lies in whether they pay dividends. Participating policies, typically issued by mutual insurance companies, allow policy owners to participate in the company's divisible surplus through dividend payments. These dividends are not guaranteed but represent a return of premium based on the company's favorable mortality, interest, and expense experience. Non-participating policies, usually issued by stock companies, do not pay dividends and are generally sold at a lower initial premium. Think of participating policies as sharing in the company's profits, while non-participating ones offer a fixed cost. Question 17. The policy provision that states the insurer's promise to pay the death benefit upon the insured's death is known as the A. Entire contract clause. B. Consideration clause. C. Insuring agreement. D. Free look provision. Answer: C. Insuring agreement. The insuring agreement is the core of the life insurance contract, explicitly stating the insurer's fundamental promise to pay a death benefit to the designated beneficiary upon the insured's death, provided all policy conditions are met. This clause outlines the coverage provided and the circumstances under which the benefit will be paid. It's the central promise that defines the insurance policy. Question 18. An Arizona resident allows a life insurance policy to lapse but wishes to reinstate it. Which of the following conditions must typically be met for reinstatement? A. the insured must prove insurability, and all past due premiums plus interest must be paid. B. Only the current premium payment is required, regardless of insurability. C. The policy must have been lapsed for less than 30 days. D. A new application must be submitted, and a new waiting period for benefits will begin. Answer: A. The insured must prove insurability, and all past due premiums plus interest must be paid. To reinstate a lapsed life insurance policy, an insured typically must provide evidence of insurability to prove they are still a standard risk, and all overdue premiums, along with any interest due, must be paid. This process allows the policy owner to restore the original policy, often retaining its original issue age and cash values, rather than having to purchase a new policy. Reinstatement is usually available for a limited period, often 3 or 5 years after lapse. Question 19. If a life insurance policy's beneficiary designation reads, "To my children," per stirpes, and one of the insured's children predeceases the insured, what happens to that child's share of the death benefit? A. It is divided equally among the surviving children. B. It reverts to the insured's estate. C. It is paid to the deceased child's heirs, example grandchildren. D. It is forfeited and not paid out. Answer: C. It is paid to the deceased child's heirs, example grandchildren. The term per stirpes means by the branch or by the root. If a beneficiary designated per stirpes predeceases the insured, their share of the death benefit does not go to the other surviving beneficiaries. Instead, it passes down to their legal heirs, typically their children, the insured's grandchildren, thereby following the family lineage. This contrasts with per capita, where the death benefit is divided equally among only the surviving beneficiaries. Per stirpes ensures the intended generational distribution of wealth. Question 20. Which of the following statements regarding the taxation of individual life insurance death benefits in Arizona is generally true? A. Death benefits are taxable as ordinary income to the beneficiary. B. Death benefits are taxable as capital gains to the beneficiary. C. Death benefits are generally received income tax-free by the beneficiary. D. Death benefits are subject to federal income tax but exempt from state income tax. Answer: C. Death benefits are generally received income tax-free by the beneficiary. In the United States, including Arizona, the death benefit proceeds from a life insurance policy are generally received by the beneficiary free of federal income tax. This tax-exempt status is one of the significant advantages of life insurance as a financial planning tool. While the death benefit is typically income tax-free, it may be subject to estate taxes if the insured's estate exceeds certain federal thresholds. Always highlight this tax-free benefit to clients as a key policy feature. Question 21. A life insurance producer is explaining the concept of insurable interest to a client. Which statement accurately describes insurable interest in life insurance? A. It requires the policy owner to have a financial stake in the continued life of the insured. B. It is only required at the time of the insured's death. C. It is only required if the insured is a minor. D. It means the policy owner must be a blood relative of the insured. Answer: A. It requires the policy owner to have a financial stake in the continued life of the insured. Insurable interest in life insurance means that the policy owner must have a reasonable expectation of suffering a financial loss if the insured dies. This interest must exist at the time the policy is purchased, not necessarily at the time of death. Examples include an individual insuring their own life, a spouse insuring a spouse, a parent insuring a child, or a business insuring a key employee. The principle of insurable interest prevents people from taking out policies on strangers and potentially profiting from their death. Question 22. Which rider ensures that if the policy owner becomes disabled or dies, the premiums for a child's life insurance policy will be waived? A. Waiver of premium rider. B. Payor benefit rider. C. Accidental death benefit rider. D. Guaranteed insurability rider. Answer, B. Payor benefit rider. The Payor benefit rider is specifically designed for juvenile life insurance policies. If the adult policy owner, the payer, becomes totally disabled or dies before the child reaches a certain age, example 21 or 25, this rider ensures that the policy's premiums will be waived until the child reaches that age or the payer recovers, keeping the child's coverage in force. It's an important protection for parents or guardians who want to guarantee their child's life insurance coverage, even in unforeseen circumstances. This rider essentially waives premiums if the person paying them can no longer do so. Question 23. An individual wants a life insurance policy that offers the greatest amount of death protection for the lowest premium. Which type of policy would best fit this need? A. Whole life. B. Universal life. C. Limited pay whole life. D. Term life. Answer, D. Term life. Term life insurance provides temporary coverage for a specific period, the term, and pays a death benefit only if the insured dies within that term. It does not accumulate cash value, which makes it the most affordable type of life insurance for a given amount of death protection. Since it focuses purely on death coverage without a savings component, it offers the highest death benefit per premium dollar compared to permanent policies. If the primary goal is maximum coverage at minimum cost, term insurance is usually the answer. Question 24. What is the purpose of the Arizona Life and Disability Insurance Guarantee Fund? A. To provide loans to financially struggling insurance companies. B. To protect policy owners, within limits, in the event an insurer becomes insolvent. C. To regulate premium rates for life and disability insurance policies. D. To educate the public about various life and disability insurance products. Answer, B. To protect policy owners, within limits, in the event an insurer becomes insolvent. The Arizona Life and Disability Insurance Guarantee Fund is a state-mandated organization created to protect policy owners, annuitants, and beneficiaries in the event that a member insurance company becomes financially insolvent and cannot meet its obligations. It provides limited coverage for claims up to certain statutory limits. This fund acts as a safety net, assuring consumers that their policies will not become worthless if their insurer fails. It's a crucial layer of consumer protection within the insurance industry. Question 25. Which of the following actions constitutes an illegal rebate in Arizona life insurance? A. A producer accepting a commission from the insurer for selling a policy. B. A producer offering a prospective client a portion of their commission as an inducement to purchase a policy. C. An insurer offering a discount on premiums for paying annually instead of monthly. D. An insurer providing a gift of nominal value to all new policyholders. Answer, B. A producer offering a prospective client a portion of their commission as an inducement to purchase a policy. Rebating is an illegal practice where an insurance producer offers something of value not specified in the insurance contract, typically a portion of their commission or a special favor, as an inducement for a prospect to purchase a policy. This practice is prohibited because it can lead to unfair discrimination among policyholders and undermine the integrity of the insurance market. Standard practices like premium discounts for annual payments or gifts of nominal value are generally permissible if uniformly offered. Remember, if it's not in the policy and has monetary value, it's likely an illegal inducement.